Over time, the market has rewarded conviction, not convenience. When we look at the data, there's a clear pattern that defies every short-term narrative or cyclical fear. Long-term outperformance isn't luck, it's the mathematical consequence of innovation, compounding, and human progress. Every decade delivers its own crises, recessions, and panics. Yet, through them all, the trend remains consistent. Those who stay exposed to the engines of growth outperform every other class of investor. The difference between reacting and understanding is the difference between surviving and thriving. From the 1920s to today, equities have compounded wealth at nearly 10% per year on average, while bonds have barely kept pace with inflation, and cash has consistently lost purchasing power. It's a stunning gap, and it widens with every passing year. The lesson here is not simply about owning stocks, it's about owning innovation, the part of the economy that is expanding the frontier of possibility. When productivity surges, when technologies redefine how we live and produce, the companies driving that change capture exponential value. Those who bet on progress, even in its earliest and most misunderstood forms, end up owning the future. But long-term outperformance doesn't come without discomfort. It requires the willingness to look wrong before you're proven right. Disruption never feels safe when it's happening. It feels chaotic, overvalued, even delusional. Yet, history rewards those who lean into uncertainty when it's grounded in a clear understanding of long-duration value creation. Think about the early internet, renewable energy, biotechnology, or artificial intelligence. All went through cycles of skepticism before their true potential compounded beyond imagination. Markets overreact in the short run, but underappreciate the long game. That's where exponential growth hides. In the asymmetry between perception and reality, the power of compounding only reveals itself over long stretches of time. 1 or 2 years of volatility can obscure a decade of quiet value creation beneath the surface. The human tendency is to overestimate the short-term impact of change and underestimate its long-term consequences. That's why investors who anchor their strategy in 5 or 10-year horizons consistently outperform traders chasing quarterly results. They're not reacting to the noise. They're aligned with the trajectory of innovation and productivity. Every period of fear, every drawdown, becomes an opportunity to buy the future at a discount. This principle holds even in environments that look uncertain today. Whether it's inflationary pressure, higher interest rates, or geopolitical instability, the underlying drivers of long-term outperformance remain the same: technological evolution, global connectivity, and human creativity. We are entering an era where new S-curves are converging. Artificial intelligence meeting genomics, robotics meeting energy storage, blockchain meeting finance. These aren't isolated breakthroughs. They're compounding systems feeding into one another. When innovation stacks, returns accelerate in ways that traditional models fail to predict. The irony is that most investors still allocate capital as if the future will look like the past. They chase safety, diversify into mediocrity, and call it prudence. But the greatest risk is not volatility, it's stagnation. The data show that a disciplined long-term exposure to growth assets consistently outperforms so-called defensive strategies. The true defense against uncertainty is innovation itself. The ability of markets and entrepreneurs to solve problems faster than crises can destroy value. History has proven this over and over. So, when we talk about long-term outperformance, we're really talking about aligning with the structural direction of progress. It's not a strategy of prediction, it's a strategy of participation. The compounding of technology, knowledge, and productivity is the most powerful wealth creation mechanism ever observed. Investors who understand this don't measure success in quarters or even years, they measure it in revolutions. Each wave of disruption redefines what's possible, and those who stay invested in that wave don't just beat the market, they redefine it. When we strip away the noise of markets, politics, and cycles, What remains are the assets that consistently align with human progress, structural change, and value preservation. Over history, patterns emerge. Not all assets are created equal. 3 stand above the rest because they each represent a distinct force of wealth creation: growth through innovation, protection through tangibility, and asymmetry through transformation. These are not arbitrary categories. They are reflections of how the world evolves, how capital adapts, and how opportunity migrates over time. The first of these assets represents growth and innovation, the equity in businesses that create new value. Equities have always been the most dynamic form of ownership because they harness the power of compounding through innovation. Every era of breakthrough: electricity, automobiles, semiconductors, the internet, artificial intelligence, has rewarded those who own the builders, not the bystanders. Stocks are not just tickers, they are slices of innovation, productive capital at work. When an investor buys into vision-driven companies, they're essentially funding progress itself. And because progress compounds exponentially, so does capital invested in it. The market often underestimates the speed at which transformative technologies change entire sectors. By the time consensus catches up, the exponential curve has already steepened, and the majority are left chasing what the early believers quietly held. Then there are the assets that anchor wealth to the real world: tangible, finite, and enduring. These are real assets: real estate, commodities, infrastructure, the scarce resources that hold intrinsic value regardless of monetary systems. Their power lies in their physicality, their limited supply, and their ability to protect against the erosion of currency value. In times of inflation, geopolitical disruption, or monetary experimentation, tangible assets become the stabilizing force within a portfolio. They are not about explosive growth, but about continuity and resilience. When paper promises lose credibility, tangible value endures. The world may become increasingly digital, but even in that transition, the foundational layer, energy, land, materials, remains indispensable. The convergence of physical and digital economies, like smart infrastructure or green energy systems, is only enhancing the relevance of real assets, making them a necessary counterbalance to the volatility of innovation-driven markets. The third category captures the asymmetric frontier, the alternative and next-generation assets that redefine what investing even means. These include private markets, venture-backed technologies, tokenized assets, and the new financial architectures emerging from decentralization and AI integration. Their common thread is structural change. They don't just exist within the system, they reshape it. While traditional investors often dismiss them as speculative, history shows that paradigm shifts always begin on the periphery. What was once alternative becomes mainstream when its network effects take hold. Early exposure to such assets offers not only high potential return, but participation in building the future financial ecosystem itself. This is where the concept of beating everything transcends performance metrics. It's about being positioned in the path of inevitability. These 3 asset types, growth, tangible, and transformative, are interconnected. Innovation drives productivity, which increases demand for tangible assets. Tangible assets provide stability that enables risk-taking. Transformative assets bridge the gap between old and new, unlocking value in both realms. Together, they form a portfolio not of balance, but of synergy. Each performs a different role across the economic cycle, but all share one trait: they evolve with progress rather than resist it. In an age defined by exponential technologies, shifting monetary paradigms, and global reallocation of capital, clinging to outdated asset models is an act of regression. The assets that outperform are those that live at the intersection of change and conviction. Growth captures opportunity, tangibility guards value, transformation unlocks new frontiers. The investor who understands how to weave these forces together is not merely preserving wealth, they're compounding relevance. In a world where disruption is the new stability, these three asset classes are not just resilient, they are the architecture of the future. Every generation experiences a turning point when the rules of value creation change, when old models of stability break and new systems emerge from beneath the surface. We are living through such a moment right now. Structural shifts are not cycles, they are rewirings of the global economy. They redefine productivity, power, and prosperity, and the greatest mistake investors can make is to treat structural shifts as noise or temporary distortions. In reality, they are signals, loud, transformative, and impossible to ignore once you understand their trajectory. Across the global landscape, the most powerful forces are converging: technological acceleration, demographic transformation, and monetary evolution. Each alone would be significant. Together, they're rewriting the investment map. Technology is no longer a sector, it's the infrastructure of every industry. Artificial intelligence is compressing decades of progress into years, making entire business models obsolete while creating new ones overnight. Robotics and automation are restructuring labor markets and redefining the cost of productivity. Energy systems are decentralizing. Data is becoming the new form of capital, and value itself is shifting from tangible to intangible faster than traditional frameworks can measure. These are not surface-level changes. They are the foundation for a completely new economic era. Demographics add another layer. Aging populations in developed economies are altering consumption patterns, fiscal policies, and savings behavior, while younger, digitally native populations in emerging markets are driving adoption of new technologies and new financial models. The wealth transfer between generations is not just a transfer of money, it's a transfer of mindset. The next generation doesn't see the world through the lens of legacy finance. They see opportunity in disruption, efficiency in decentralization, and trust in systems built on transparency rather than hierarchy. Capital follows belief, and belief is rapidly shifting toward innovation-driven ecosystems. Monetary evolution completes this structural trifecta. Decades of low interest rates, quantitative easing, and fiscal stimulus have redefined what money means, where it flows, and how it's valued. The lines between fiscal and monetary policy are blurring, while inflation and currency volatility are reshaping how investors perceive safety. The traditional store of val, ulage, anchored in bonds or fiat currencies, is being tested by real assets and digital counterparts that offer both scarcity and transparency. As central banks recalibrate liquidity, dynamics will favor assets that thrive on innovation, adaptability, and real productivity. The financial architecture of the past century is not equipped for the digital velocity of the new one. What does all this mean for investors? It means that diversification based on yesterday's assumptions is no longer protection, it's paralysis. The idea of a static allocation strategy assumes a static world, but the world is now in constant acceleration. When structural change accelerates, the opportunity cost of staying anchored to old paradigms becomes immense. The assets that outperform are the ones aligned with the structural direction of progress. That alignment requires vision, driven conviction, and a willingness to embrace volatility as the price of asymmetry. Consider what happens when technology converges with energy, or finance merges with AI and blockchain. Entire industries dissolve their boundaries, and new trillion-dollar ecosystems emerge almost invisibly at first. Investors who wait for proof will always arrive late because the proof comes only after the majority of value has already compounded. Understanding structural shifts means learning to see leading indicators in innovation adoption, in behavioral change, in capital flow redirection. It means recognizing that the future doesn't unfold linearly, it leaps. The beauty of structural change is that it rewards those who think exponentially. the market still discounts exponential trends as if they were linear, which creates opportunity. Whether it's the digitization of finance, the reconfiguration of energy, or the rise of data-centric economies, the direction is unmistakable. The question is not whether these transformations will happen, it's who will have the conviction to stay positioned through their volatility. The real winners are not those who time the shift, but those who align with it early and let time amplify their conviction. Structural change isn't risk, it's the roadmap of the future. The difference between extraordinary outcomes and average ones rarely lies in the asset itself. It lies in how the investor behaves around it. Execution is the quiet force that compounds conviction into results. Too many investors chase what looks like the best asset on paper, the highest yield, the fastest growth, the most fashionable theme. But the truth is, the best asset in the world can still underperform in the wrong hands, while a mediocre one can outperform through discipline, timing, and patience. Execution is the bridge between intelligence and outcome. It's where strategy becomes reality. In every era of disruption, there's an obsession with discovery, finding the next great company, the next gold rush, the next moonshot. But history teaches that the real differentiator isn't discovery, it's endurance. The compounding effect only works when you give it time. Execution is the art of staying the course through volatility, of resisting the impulse to trade conviction for comfort. The market constantly tempts investors to act, to react, to second guess. But the data are clear. Those who trade less, think longer, and anchor to long-term vision outperform those who chase the latest opportunity. Execution, in essence, is emotional discipline quantified. Timing the market has destroyed more wealth than it's ever created. Investors are wired to seek control, to believe that perfect timing can maximize return. But markets don't reward perfection, they reward participation. Missing even a few of the market's best days has historically cut long-term returns in half. That's not about bad luck, it's about poor execution. The investor who consistently deploys capital, reinvests through downturns, and lets compounding do its quiet work will almost always outperform those trying to outsmart cycles. In execution, consistency beats brilliance. The paradox is that most investors know this, yet few practice it. That's because execution isn't exciting. It's methodical, patient, and uncomfortable. It requires conviction in moments when narratives break down, when headlines scream panic, and when sentiment turns against logic. Execution means adding to positions when fear dominates, trimming when euphoria peaks, and always acting according to principle rather than emotion. It's not about predicting what comes next. It's about preparing for whatever comes next. The great investors don't have perfect foresight. They have frameworks that allow them to act rationally when others can't. Another dimension of execution is understanding allocation. Even the right idea can underperform if capital is misallocated. Diversification isn't about owning everything. It's about owning the right things in the right proportion. Execution means rebalancing when momentum distorts risk, taking profits when position size grows faster than conviction, and redeploying capital into the next compounding opportunity. It's strategic movement within a long-term framework, not reaction to short-term volatility. This is where most investors fail. They confuse activity with productivity, but in investing, action without discipline is just noise. Great execution also requires intellectual humility. The world changes faster than our biases adapt. A strong thesis should not become a religion. It should evolve as data evolve. Execution means being decisive without being dogmatic, holding conviction but welcoming new information. The investors who endure aren't those who are always right. They're those who adjust quickly when they're wrong. That adaptability is the essence of good execution. It's not about never missing. It's about never staying off course for long. Ultimately, execution transforms vision into performance. Anyone can identify megatrends, innovation, AI, clean energy, decentralization, but only disciplined execution captures their value. The compounding curve rewards time in the market, not timing of it. It rewards patience through volatility, not reaction to it. The investor who executes with consistency, adaptability, and conviction will always outperform the one chasing perfection. Because in the end, it's not the best asset that wins, it's the best behavior around it.